Hi, Jack the Life Man here. I'm here to explain to you in a very simple way about universal life insurance. What is it? What does it mean? What's all the confusion about? Universal life insurance, what we commonly refer to as UL. Basically, anytime you hear that word, it means that there can be or is an option for investment. So it's an investment component with life insurance added in. And there's two kinds. And I find this product to be very confusing if you don't get an honest broker. Honest brokers will explain to you the differences between the two. The first one we'll talk about is the Term to 100. It's called Term 100. It's a level cost insurance. It means that your monthly payment will stay, we'll use $100 as an example. It'll stay the same for life up till age 100. So that premium will never change. And if you want to add any money on top of that $100, you can add some extra cash. They give you a minimum and a maximum, like an RSP almost. And that money is put into an investment where it's tax sheltered. And the nice thing about universal life is that when you die, well, obviously that's not a nice thing, but when you do die, the death benefit will be paid out tax-free along with the profit that you made on the investment. So that's a pretty good thing. Not even an RSP does that, because even if you die and the RSP goes to your spouse, when they take out that RSP, they're still taxed. Which is different than the universal life. Now, when I said about honest brokers, an honest broker will explain to you the difference between what we call a YRT and a Term 100. Already, you think I'm trying to trick you, but YRT stands for Yearly Renewable Term. And sometimes they'll show you that same $100 premium, but they're not explaining to you what this YRT stands for. Yearly Renewable Term means that every year you get older, the cost of insurance will change. With a Term to 100, we know the cost of insurance is $100 and it'll stay at $100. But with a YRT, how they get around that, for example, let's say when you're 30 years old, your cost of insurance is $30. Your investment portion will be $70. And 70 plus 30 equals 100. Now you turn 40. Now when you turn 40, because you're getting older now, your cost of insurance went up. The older you get, the more expensive the insurance. So now you can only put $50 into the investment, and it goes on. 50, 70, 30. When you turn 60, it's $90 cost of insurance, $10 investment. When you turn 70, the cost of insurance actually goes higher than what the $100 amount is. So what you see happening here is you see the cost of insurance rising and rising and rising. It's not guaranteed, it's not level like the other one I showed you, and the investment is just, it keeps on going down. Now, essentially what you want happening with this is that in the early years, you're hoping that your investment will do well and it will fund those rising costs of insurances down the road. Now, I don't recommend this product to families who are looking for guaranteed insurance, because there's a big element of risk here, especially when you see what happened with the market in 2008. And if we're going to get hiccups like that along the way, then you don't want to have to, when you most need the insurance, you don't want to have to add more money in to keep it going. So I always recommend, if you are going to do universal life and you like the investment component to it, stick with a level cost Term 100. Don't go with a YRT. I hope that was helpful. I don't think it's too confusing, but if you have any questions about it, I'd be happy to go over it with you in person. Jack the Life Man, signing out.